Welcome back to another podcast with Mr. Hagan. On this podcast, we're going to continue to talk about the stock market. And I just want to remind everybody that this video is not designed to give investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, let's continue to talk about the stock market. On the last video, I talked about why you would want to own shares in a company, and the primary reason was to share in the earnings or the profits of the company. And we want to talk about that in a little bit more detail here. So let's go check it out. So when we think about owning stocks, what we're really asking is why would we want to do that? And we said that the reason is because we want to share in the earnings of the company. But what's that actually mean? What what's the actual way that happens? So let's think about a company and what it can do with its earnings. A company really can do two things with its earnings. It can either pay a dividend or it can reinvest. Those are the two things that a company can really do. So let's think about that a little bit. Remember what it meant for a company to have earnings. What you're really doing is you're taking your revenue minus the company's costs, and that's equal to the profits that the company makes. That's equal to the profits that they make. And so those profits, they can do two things with those profits. They can either directly pay a dividend, or they can reinvest those earnings. Now, we'll talk about reinvesting in a second. Let's start first by talking about the dividends. One thing that a company can do with its earnings, so if this was Microsoft and they made, let's say that they made $500 million in earnings, they could take that $500 million and they could make dividend payments. What that literally means is they take a portion of the profits or the earnings, that means the same thing, and they pay that out directly to the investors or the shareholders in the form of a dividend payment. And those dividend checks would typically come every quarter. So if you own shares in Microsoft, every quarter you would get a dividend check from Microsoft. Now, how much of a dividend check do you get? Well, it depends on the company's earnings. It depends how much they pay out in dividends, and it depends on the percent of the company that you own. So the percentage of your dividends that you receive is equal to the percent of the shares that you own. So what I mean by that is, if you own 10% of the company, if you own 10% of all the shares, then you will receive 10% of all the dividends, and that will be paid out to you on a quarterly basis. So that's a direct way that you would be sharing in the earnings of the company. Now, the other thing companies can do with those earnings is they could take those earnings and they could reinvest them. They could reinvest those earnings. So that might mean this. That might mean that Microsoft might take $500 million of earnings. If they have $500 million of earnings, and they reinvest it. What does that literally mean? That literally means that they go buy capital. And what is capital? We talked about that on some of our earlier videos. Capital is just a tool for further production. That's what capital is. It's a tool for further production. And so what that might mean for Microsoft is maybe they go out and they buy more laptops that their engineers can use to write software programs. And so reinvesting means that the company will go buy more capital or tools for production. Now, why does that matter? Because if they do that, then they will earn more profits in the future. If you have more engineers with more laptops who are writing more software programs, then you'll make greater profits in the future. Why does that matter? Because if investors think that Microsoft's going to make more profits in the future, then they're going to want to buy more stock right now, today. So what does that look like on a supply and demand graph? Well, let's say this horizontal axis, this is the quantity of shares. These are the quantity of shares trading in the market. And then up here on the vertical axis, this is the price of the shares. This is the share price of the company. So that's where the share price comes from. It comes from supply and demand. Over here, the supply curve, this would be the investors who are selling shares in the company. And then the demand curve, this is people who want to buy shares in the company. Right here would be your equilibrium price and your equilibrium quantity. Now, let's say that the equilibrium price originally was $30. Based on the supply and demand for the company, the original share price was $30. Given the people who are selling the stock, given the people who want to buy the stock, it currently is selling at a share price of $30. That's the current price per share. Now, Microsoft then announces that it's going to reinvest $500 million. And it's going to use that $500 million to buy more laptops so that its engineers can write more programs. And that means that they're going to have higher profits in the future. So people say, oh my goodness, higher profits for Microsoft. I want to buy that company. And so the demand curve for shares of Microsoft will shift to the right. The demand curve for shares in Microsoft will shift to the right. And so what happens as a result of that? So what happens as a result, of course, is you're going to end up with a new equilibrium. Right here is going to be your new equilibrium. When the demand curve shifts to the right, that means that we're going to get an increase in quantity. That means more shares are going to be bought and sold in the market. But it also means you're going to get an increase in the price of the shares. So maybe the new share price will be $40 per share. So think about how you just made money. You could make money two ways. Number one, you can make money directly. The company pays you a dividend. But number two, you could make money because the company reinvests the $500 million in new laptops, in new capital, and that means they'll earn greater profits, which will make people want to buy the shares of the company. That will shift the demand curve for shares out to the right, and that will bid up the price. So there were two ways that you, the investor, could make money. Two ways that you, the investor, could make money. Way number one was you could get a dividend payment. Okay, you could get the direct dividend payment from the company. The company pays you a dividend. You make money. That's it. They take some of their profits and they send it to you in the form of a check, and that's called a dividend. That's the first way that you make money. Number two is the second way you make money is you get an increase in the share price because of the reinvesting. Okay, the company earned profits. They reinvested it in new laptops. They're going to make more money in the future. That makes more people want to buy the stock, and that's going to bid up the price. And so this investor, they bought this company at $30 per share, but now it's worth $40 per share. That is called a capital gain. That is called a capital gain. That is called a capital gain. So capital gain really is when you buy something at a low price and then you sell it at a higher price. Okay, those are called capital gains. You buy something at a low price and sell it at a higher price. In this case, you bought it at $30 and you sell it at $40. So really you made money because there was an increase in the share price. You made money because there was an increase in the share price. So let me just review that. There are two ways that you can make money. There are two ways to make money as investors. Two primary ways that you can make money. One is you own shares in a company because you want to share in the earnings, and you could do that in the form of a dividend payment. Those are direct payments, sharing the earnings with the customer, with the shareholder. Sorry, not with the customer, with the shareholder. The second way that you make money is reinvesting, which makes people want to buy shares of the company, which bids up the price, and we call that a capital gain. Either way, you, the shareholder, made money in the form of either a dividend or a capital gain. All right. Thanks for joining me. This has been Mr. Hagan on another Econ podcast, and we'll see you on the next podcast.